to the Q3 2023 Astute Quarterly Market Update. I'm Hannah Owen, Head of Group Communications, and today I'm joined by Dr. Scott Osborne, our Chief Investment Officer. So Scott, I've got a few questions to pose to you today. The first one being, as we sit here today, the Bank of England increased interest rates again yesterday by 0.25% to 5.25%. We talked recently about mortgages and the impact that that's going to have there on mortgages and on the economy. Bailey said yesterday that policy is restrictive, and I believe you said that for the first time. So what does this mean? Yeah,
good question. Yeah, sounds ominous, doesn't it? So restrictive policy, what does restrictive really mean, for us in our everyday life? Yeah, so, bear in mind the purpose of the Bank of England's mandate, and other banks around the globe, but we'll just talk about the Bank of England today, is to control inflation. And at the moment, clearly, they've not done a very good job of that. But that restrictive policy stance, this whole idea of restrictive, is that you are literally restricting the economy. You're restricting the amount of growth the economy can have in order to sort of strangle off that inflation. You basically want to stop people consuming. You want to stop them paying higher prices for things, and there's all this sort of second order effects that feed from that, which will then ultimately bring the inflation number down. So it is ominous in the sense that they are trying to basically slow the economy down, and that can and may lead to a recession still. But ultimately it is their job and it is the purpose of policy. If we think about sort of a few tangible examples of how restrictive policy is supposed to operate, obviously we've talked about mortgages in the past. That is a big one, particularly in the UK, where we have these floating rate mortgage markets, or at least we have short-term fixes that regularly drop off. But there's lots of other methods as well. Obviously, the cost of other borrowing, whether you're a business or whether it's just a loan or a credit card or whatever, that all goes up, and it makes people less likely to borrow money to make purchases. Again, bringing down that marginal propensity to go spend some money on a good or a service. The flip side of that is savings rates. Obviously savings rates go up, and although the banks have been in the sort of crosshairs a little bit for not increasing sight deposits, so like the interest you get on your cash account, we have seen fixed term deposits go up quite markedly. And what that does, it not only does that, is it good for savers, but it basically sucks capital out of the economy, and it just sits there static in a bank account not doing anything. And that money otherwise could be spent, or it could be invested, and then wherever it's invested, those companies could spend that money themselves on capex, etc. So there's the two sides of the coin. There's the one which is stop people borrowing to spend, and then there's the other one which is stop people spending the cash they have and encourage them to put it somewhere else and just sort of sit on it. The tricky bit, and probably if you give them a little bit of slack post-pandemic and everything, is we really don't understand how those two big dynamics operate through the economy. And for a good example, in the UK, we had all these labour market problems, but if we think about the early part of the pandemic when inflation wasn't quite here but was getting going, there was also a big fiscal stimulus. The biggest beneficiaries of that were probably working age population, because they were getting things like the furlough scheme and so on. They were basically getting paid not to do anything. Meanwhile, the other side, the savers, they were really worse off, because not only were savings rates zero, but they were about to get hit by a big market drawdown, particularly in the bond market, as we saw last year, the end of the year before. So their wealth was going down. So the dynamics of who was spending money and who had money to spend at that time was very different. And as we've moved through the cycle, we've seen that change, and people have gone back to work, and savings rates have gone up. We've had probably a big cohort of people retire that aren't going to go back to work. We've also got a big cohort of people that are long-term sick because of the NHS waiting times. That's massively changed now, the dynamics of who's got money to spend, what they want to spend it on, because it was goods, now it's services. These are all very complicated, interlinked dynamics that are occurring in the economy that the Bank of England is trying to guess, basically. With interest rates where they are, all that tangled mess that I just talked about, have we got policy restrictive enough that on balance across that piece, people are going to consume less or want to consume less? And for the first time last night, as you said, Andrew Bailey, the governor of the Bank of England, said, actually, we think we're here now. That doesn't mean they won't increase rates further. They still might want to do that, because yes, inflation's coming down, but it might not be coming down fast enough. And the other thing, the open question, is how long will they keep rates at this level for? I.e., how long do you want to have that stranglehold on the economy for? in order to get inflation back down to target is still a very long way from the 2% target. So yeah, I think it is a big moment. You know, we said last time about we think we were reaching the peak in policy rates, and actually they've gone a bit further than what we anticipated. But I think all three major central banks now, the US, the ECB in Europe, and the Bank of England yesterday, have acknowledged that they think they are in a restrictive sort of part of the policy stance. So they do think that they're getting inflation under control from here. There's just an open question about how long and how much further they may need to go in order to get inflation back down to target. But we do think that once you're in a restrictive stance, you can basically say, okay, well, we would expect rates to be lower than this in the sort of, you know, ad infinitum into the future. If you're in a restrictive policy, then the natural rate for interest should be lower than that restrictive stance, because obviously you don't want to maintain restrictive policy forever. So we also kind of have a clue now that this might not be the peak, but when rates start to come down, they should come down to slightly below current levels, which is another big indicator for us and how we position portfolios. So yeah, sounds scary, is a little bit because it's slowing the economy, but is actually probably quite a good thing for us in terms of building portfolios. It gives us a little bit more clarity on, you know, the rest of the year and where we finally get to the end of these interest rate cycles.
Okay, so to pick up on something that you said there, rates on savings accounts have been so low for years because the base rate has been low, and now the base rate is 5.25%. Then hopefully people on their cash savings are getting not much less than that. With that being the case, should investors now be looking at putting more of their money in cash?
Yeah. I mean, this is a big question at the moment, right? Obviously, we in the funds we can allocate some of our capital to cash, and we get those fixed term deposit rates. So we've seen money on cash funds, like we say, and these tend to be slightly better rates than what you would get with a fixed term deposit because it's institutional, with only slightly higher risk. We've seen those rates go up, and yet in the portfolios we haven't been allocating more to those areas. We've been allocating less, and the real reason is that as that base rate goes up, we call it the risk-free rate, right? Because if you lend to the UK government, in theory, it's risk-free. You're going to get your money back. As that risk-free rate goes up, that additional sort of premium, so let's say that the extra 5% interest that we're getting versus a year and a bit ago, that has to be reflected in every other asset class as well. Because there are some areas where maybe it wouldn't be passed on in its entirety, but in theory, if the risk-free rate goes up 5%, then all of their assets have to add that 5% on as well, because they're relative to the risk-free rate. If they weren't going up by 5%, or at least yields is a kind of abstract concept, but if there wasn't increased value elsewhere in risky assets, then they wouldn't be as attractive. Mm. And that's the real reason why bonds have fallen in value, right? Because a bond which was issued 2-3 years ago is paying a much lower rate of interest than a bond issued today, and so it's fallen respectively. Now, we don't think cash is a good place to be, simply because we think there are much better returns available on risk assets. It's as simple as that. And whilst optically a sort of nominal level of 5% or plus on looks very attractive, because we all like to make money, right? It's nice to see you've got £100 and in a year's time you're going to have 105. But the point is that 105 is probably maybe going to keep you level with inflation, maybe a little bit behind, maybe a little bit ahead. And historically, cash rates have very, very rarely ever beat inflation, for good reason. That if that's the case, then there's probably policy rates are about to start falling again. So we think the focus for us remains on beating inflation. That's really our benchmark. Obviously, inflation's got a bit of a head start with the last 2 years of everything that's gone on. And we think in order to catch back up, you really do need to be taking risk in the market. And there's a good chance that if you sit out for even a short period of a year, you might miss one of those little rallies, which is essential in basically making up that lost ground. And so we would suggest that whilst it looks optically attractive to go for 5%, you probably will get more on risk assets over the course of the sort of next 12 months. It's just uncertain because of that, all the stuff we talked about where policy rates go and go forth. But for us, the balance of risk is much more towards worried about missing the next rally than it is about worrying about, another short-term pain. And really, that's how we're positioning the funds, and that's how we think investors should position as well, depending on your time horizon. Obviously, if you've got a sort of 1 year liability that you need to lock in, then fixed term deposits are very useful for that stuff. But as you push that time horizon out, you should really be focused on real returns above the rate of inflation, and we just don't think even fixed term deposits at these levels will deliver those returns. So you have to stay invested in risky assets, which, let's face it, look quite attractive at these levels. You know, we've had 2 years of basically nothing, and valuations are attractive. It's a good entry point to think about below average valuations, high but falling inflation. These are good. This is a good environment for investing in risk assets. The fact that 5% looks very optically attractive, you know, is a bit of a distraction, we think.
Brilliant. For my next question, I've turned to the help of AI. Hi, Scott Osborne. As a fund manager, what are your thoughts on the impact of AI on financial markets?
Right, yeah, so a guest appearance from ChatGPT there, is it? Yeah, obviously the AI thing has been a big theme so far this year, and there's a lot of talk about these 7 stocks which have driven particularly the US market, where obviously there's more technology. Nvidia being a big one. Nvidia is the company that makes the sort of graphics processing units, which have really been crucial in establishing these artificial intelligence networks for people to then, you know, create things like ChatGPT. And that stock's, you know, more than doubled. It's been on a real flyer. And there's also sort of the companies kind of doing stuff with AI rather than the sort of picks and shovels of the industry. Microsoft have this relationship with OpenAI, which own and operate ChatGPT. Google is another company which is big in the artificial intelligence space. But it is to a certain extent still a bit of a solution without a problem. You know, there's lots of companies desperate to make it look like they're implementing AI within their processes or within their businesses to increase revenue, sales, etc. But it's not really clear exactly how well that's going to go, or you know, how widespread it's going to go, and that's creating a little bit of hype around the topic. So whilst we still are positive on technology, and we've had a technology thematic through the funds since we launched, we're still very much in the camp that says technology is essential for the global economy to progress in terms of increasing productivity, aging populations, etc., etc. We do think that the AI sort of hype has got a bit hot so far year to date. Having said that, look, going back to the picks and shovels, you know, whilst it might not be clear how certain businesses implement AI, and they're probably overestimating how useful it might be in terms of, you know, replacing staff members and so on and so forth. What we do think is attractive is those picks and shovels. So Nvidia, like I said, who make the chips, behind them there's TSMC, which is Taiwan's semiconductor manufacturing. They are the only company currently which can make the really small chips which then go into the Nvidia processing units. And then even behind TSMC, there's ASML, which is a European company, which builds the machines, these lithography machines, which are crucial in order to produce those very small chips which TSMC make, which then go into the, you know, so there is this very long supply chain that you can invest in, which is kind of monopolistic in a sense. There's very few competitors along that chain, but that does also make it very expensive. And so whilst we are interested in the potential applications of this and in technology more globally, we're a little bit cooler here just because of valuations and particularly in that supply chain, which is the most attractive part. So yeah, one to watch, but we won't necessarily be sort of diving in or increasing our exposure there anytime soon. We do have a reasonable exposure already, and I think we're probably quite happy with the amount of that we're getting to that theme currently.
Brilliant, thank you, Scott. That's all we've got time for today. If you've got any questions about anything that we've covered here, please speak to your financial planner. And on a final note, the VT Astute Funds were launched 3 years ago and have reached their 3rd anniversary. So look out for a video dedicated to the topic. See you soon.